welcome to the show.
All right.
Your TSP Weekly Podcast.
I wonder if people watch this podcast and be like, "These guys are knuckleheads."
I hope they don't think we're knuckleheads, but I probably think we're weirdos.
Yeah, I mean, anybody that's got to be this deep into TSP is got to be a little bit off the rocker anyway. But
yeah, I was just telling my daughter. I was talking to one of my daughters on the way down to Southern Virginia yesterday. And that's exactly, we were talking about how, you just can't think, if you told me 30 years ago that I'd be having a podcast talking about the thrift savings plan, right. I couldn't have stopped. I would have died laughing so hard.
Right.
I'd have been like, you're out of your freaking, what? Right. I shoot bad guys.
That's what I do. Right.
I'd kick down doors.
I had no. I wish I had an interest. I wouldn't have been looking for bad guys. I'd been looking for money.
When your back hurts as much as mine does now, you don't chase bad guys. You talk about the TSP.
Yeah. Well, everybody's got to evolve into something, and here we are.
Yeah,
dude, a lot of stuff to get to this week. All right,
let's get into it.
So we'll talk about what happened this week. It's going to be a quicker summary. There wasn't really all that much economic data this week, but. And then talk a little bit about building your plan. We've been talking about this here for a while between me and Conan, and I just want to kind of touch on a couple of things, make sure people are thinking about. It's not a casino. You need a plan to effectively manage your TSP. And then we'll take a look at seasonality, where we're at, where we should be. And I got a pretty good chart. There was a comment on Facebook that's going to go to this deficits, GDP, and the S&P 500. What exactly? A lot of people freak out, as well they should, that our national debt is $35+ trillion, and the deficit is over $1 trillion a year at this point. But what does that actually mean for the S&P 500? And then we got a question from the last podcast and TSP Fund charts. So Monday, nothing really significant in terms of economic data, but the S&P liked it, was up 0.77%. Tuesday, New York State Manufacturing Index came in at minus 11.9 in October versus a positive 11.5 in September, and the analysts' expectations were of a positive 3.8. So the economy is definitely continuing to weaken. That's the background of this whole thing. Even though prices are continuing to go up for stocks, the economy is definitely weakening. And so S&P was down 0.76%. Wednesday, you get Mortgage Bankers Association, their version of the 30-year mortgage rate moved up for the second week in a row from 6.36 to 6.52%. And again, mortgage applications fell to minus 17 from minus 5.1% last week. So the long rates, the TLT and the 30-year mortgage rate, they're not coming down, right? They're going up over the last couple of weeks, even as the Fed rate cutting cycle has begun. And the S&P was up 0.47%. Thursday, initial jobless claims were 241,000 versus an expected 269,000. So that's better, right? You get fewer jobless claims than what analysts expected. The 4-week average rose to 236 versus an expected 232, so basically flat. S&P's down 0.02%. And on Friday, basically all the housing numbers, building permits and housing starts are both down for the month and below analysts' expectations. But the market liked it. I don't know, at 3:30 or so, we're doing this a little bit before the close, but 3:30 the market was up 0.37% on Friday. So all in all, it's going to end up being a pretty good week. Okay, so building your investment plan, right? We're going to be putting a lot more emphasis on this in the on our website, but what it comes down to, everybody's circumstances and risk tolerance is different. Your personal circumstances, the biggest ones, whether you're just beginning your career, you're in the middle of your career, you're at the end of your career. Do you have access to other income? Right? Do you have like a single income family and a bunch of kids, or are you single and you're GS15 and you're making a ton of money and you max out TSP and you're looking for a financial advisor to help you with the rest of your money? I mean, government employees and military guys too, run the range. So everybody's personal circumstances are different. what's your risk tolerance? That can go to your emotional risk tolerance. Like, do you not want to stomach the ups and downs? Or if you're in retirement, your risk tolerance should be way lower than if you're just starting out your career. And then your time frame, obviously, when do you need the money? And your knowledge base. Like, do you want to have anything to do with this stuff? Do you want to just invest it and consider it like a savings account? Or do you want to learn how to, watch the stock charts and understand how price trends and manage it that way? So I basically say all this because there's a lot of FOMO in the Facebook group.
Yeah. And that's where we get a lot of our feedback. I mean, not everybody that watches this show maybe is not in the Facebook group. So if we got more comments on the YouTube sections and other things, we'd have more to work with. But generally speaking, we got 35,000 people in a group, and we hear and see a lot of things in there, and we have to use that as kind of our barometer, for what's, what the pulse of what people are thinking out there. And it's so rare that we hear people talk about, oh, this is going according to plan, or this is not going according to my plan. I think I'm going to adjust it. Not ever, but we don't hear that very much.
Right.
And that's what worries us because, financial planning is not a new thing. And it's amazing that people don't take that kind of framework and put it to work in their TSP because, most of the feedback when we start talking about financial planning is, well, I can't find a financial planner that'll help me, manage my TSP. Well, that's because they can't make any money off of it. And that's,
right.
That's fair,
right.
But it sucks. Fair meaning that they're not going to do it for free.
Yep.
And if you don't have any money for them to manage outside of the TSP, they can't really make any money. Right. So that's why, and they're in business, right? And so what that means is you don't have a lot of financial planners that are willing to help you make a plan. Right. So you have to take that on yourself.
Yep.
You have to sit down, and those things that Jerry had up on, pull the slide back up, those things that Jerry laid out right there, are 4 of 7 to 10 things that a financial planner would walk through with you and get you to answer all these questions so they can see what your world looks like.
Yep.
And then help you make some decisions based off that. And it's better when you have an expert helping you do it, but you don't absolutely have to have one.
No, and if you don't have the option, because you're not going to find someone that's going to do it for free, then you need to buckle down and figure it out.
Figure it out.
Not figure it out. You can, obviously we're talking about it. It's not like you have to completely figure it out from the blue.
Yeah, and I mean, one of the big courses that we're building now, and I keep bringing them up, and I know they're not out yet, but we keep fine-tuning things and trying to get it to work the best. And it's always going to be a revision in process, yeah. And but this is part of it, taking a course that will help you build a plan and help you revisit that plan once a year, because you should do that. You don't want to change your plan every month, which is another thing we see a lot.
Well, the problem, from my perspective, from reading through Facebook and stuff, I don't think people really have a plan, and so the default goes to a gambling mentality. And you can. It's very easy to pull out a chart and say, yeah, but the market always goes up and to the right, and that's true. Until it doesn't, but it goes up and down, and sometimes it goes down and stays down for a while. We talk about it quite a bit, that the value of avoiding those big drawdowns is huge. On even if you're just starting out your career, the volume. If you have $10,000 in TSP and you lose half of it, and you're 25, and you're like, meh, it doesn't matter. I got plenty of time to make it back.
Because that first 100,000 generally,
it takes forever.
Hardest.
Yeah,
and then after that, because of compounding, and hopefully you're matching and maybe giving a little bit more, and it starts to really pay off after that $100,000 mark, and then all of a sudden it becomes $300,000 or $400,000.
Yeah, that's the thing that I think everybody would agree. I don't think this is something that people wouldn't agree with, but the conventional wisdom is that be super risky when you're young in your career because you have plenty of time for the market to come back, which is true. It's just that it takes a long time for that snowball to get going, because once it's going, you can make a lot of money. But if you take big drops, I mean, I would hate to be the people that came in to the market, let's say in 95. You come in, the market's going straight up. Now, there was no TSP back then, but let's just say there was. You're in the C fund from 95 to 2000. You're killing it, right? But then from 2000, it goes down 50% to 2003, back up to where it was in 2000 by 2007, down 55% by 2009. It takes until 2013, so 14 years, to get back to even. So you were ripping for your first 5 years. And then for the next 14 years, it went sideways, right? It went down and up and down and up, but a big W sideways. That's half your career, if not more. So, I don't know if the top is near, right? There are a lot of people that are concerned about different headwinds, and there are plenty of them. There are plenty of potential reasons why the market could roll over anytime. And it's in an uptrend. It's not rolling over. It hasn't rolled over. It's in an uptrend.
Yeah, and that's you just got to respond to what it's doing and not worry so much about what you think it might do. You don't know if it's going to go, if you're going to fall on black or red, right? You don't know if you're going to get 21 and black. This isn't a game. Yeah. And so when you're playing, poker, when you're playing and gambling, you're gambling on a football game. You're gambling on something you can't control, right? And for a lot of people, that's fun. And that's okay. Just don't use your retirement account to do it, right? Have a plan, execute your plan, revise your plan when it's not going so well, but base it off of, knowledge and experience and
what the market's doing.
What the market's doing. If the market is telling you that it's going down, it's going down. Yeah. And there's no such thing as buying cheap. And we could do a whole show on this topic. But back to Jerry's slide, I'll get us back on track. If you just write these things down, these 4, this isn't probably everything you'd need to consider, but it is definitely the core of what you'd need to consider. Sit down and think where you're at in your life, in your career. What are your circumstances? Are you dual income, single income? All those things that really help you reflect on where you are financially. Yeah. That's a good place to start. That has nothing to do with TSP. Yeah.
None of this has anything to do with TSP.
Right. This is really just, planning your financial life. And then you have to be very honest with yourself to understand your risk tolerance. Like Jerry said, again, just to kind of get back on track here, if are you the kind of person that can't sleep at night if you're too invested in the stock funds and you're just too much anxiety? Okay, well you need to be honest with yourself.
About it.
Yeah. So anyway, you guys get the idea. Build your plan, man. Yep. Build your plan and execute.
It's the place to start. All right. Speaking of a plan, a lot of people use seasonality as a plan. And it generally works pretty well.
Or as a strategy.
Strategy, yeah.
As part of your plan.
Yeah. So seasonality tends to work pretty well. This chart, the blue line is election years, and you're going back 59 years. It ends in 2009. I'm not sure if that's a typo, but let's just say it ends in 2009. So we're looking at historical data, but we're going back 50 years from 2009. So the blue line is the average S&P 500 returns, or the direction anyway, during election years. And the purple line is all years, right, on the average year. So generally speaking, we get a dip in April, May, right, regardless. And we tend to get a dip in September, October, whether it's an election year or not. But specifically on election years, we tend to get a pretty big dip in October, right? We didn't get that this year. So if we kind of drew out the line, if we called, it's September, October, it's, we're up here. We should be at a low, and we're at an all-time high. As of today's close, it's another new all-time high. So does that mean, the dip is going to come later? Does it mean that, okay, the timing of it, there are reasons why the market always goes up after the election. So those reasons haven't changed. So does the market just keep going up and we just avoided the dip this year? There's no way to know. It's going to be really interesting to see what happens over the rest of the year, because at least part of the reason that you get this big move higher is because you're coming into it from a pretty significant decline. And obviously we didn't get that this year. So it's going to be pretty fascinating to see what happens going forward. All right, there was a really interesting post somebody put up in Facebook, and I'm not going to go into the post right now, but the idea was, and I think a lot of people look at it this way, the deficit and the debt. So the debt's like 35 plus trillion, the deficit's like $1 trillion a year, if not more, and the idea is that eventually, other countries aren't going to buy our bonds, and we're going to be in trouble, right? It's going to affect the market. Things are going to be in trouble. But if you look at it over time, which was the point of this chart, this is going back to here's 1928. Okay, so this is the annual these lines. It's the annual federal deficit as a percentage of GDP. Okay, so when the deficit goes up, the stock market goes up. When the deficit goes down, the stock market goes down. So when the government is acting in a deficit, when they start printing money, the money goes into the market. And so when we start ramping up deficit spending, the market goes up. When we stop, when the Fed stops printing money, that's when you start to have problems in the S&P 500. And right now, we're printing these monster deficits. So the idea that we're going to get some kind of big crash while the direction of deficits is up is very difficult, because there's so much money in the system and so much new money getting pumped into it. It's almost, I've heard people say it's impossible to have a recession in this kind of environment. And GDP now just came out with like the third quarter. I guess the third quarter is still estimated, they haven't come up with a final number, but it's like 3.4%. GDP is like 3.4%. You can't. One of the definitions is 2 negative quarters of GDP decline. We're not anywhere near that. So yeah, there's all kinds of headwinds and all kinds of possible things that could happen. But from an economic perspective, the odds, the conditions aren't there for a recession right now, amazingly enough. All right, so we had this pretty good question from the last podcast. We were talking about trueflation in that podcast, and I did a couple of slides about it had the trueflation graph, and they had one that overlaid with the S&P, one overlaid with gold, one overlaid with real estate. You can go back and look at it in last weekend's podcast. But somebody put a comment in there. There's nothing wrong with gold. However, it's an investment vehicle. However, it's not an investment vehicle, but more like a savings vehicle. I would love to see a chart comparing gold versus the G and F funds for the past few years. So I thought that was a pretty interesting question. And I went back, and since we now have the actual funds, right, that's our actual G fund, I did a ratio chart of GLD, which is an ETF of gold, to the G fund. And amazingly, this is what it looks like. So we went back to 2005. So gold is the numerator. So when the line is going up, gold is outperforming the G fund. When the line is going down, the G fund is outperforming gold. And the ratio, I mean, it's...
just to be clear now, if it's going sideways, they're about the same.
They're about the same.
So
yeah.
that whole space in there where it's kind of sideways, that's how you would think of that.
All of this, yeah.
That was just kind of for me and for the audience to remember, like, there's 3 ways it can go, up down, and sideways.
Yep.
Yeah.
Yep. So from a ratio perspective, going back all the way to 2005, gold was way outperforming until it peaked, and that was in 2011. And obviously, 2008. So let me see. 2007 was the great financial crisis, right? So gold obviously was outperforming stocks and everything, basically, because gold was going up because everybody was kind of fleeing to gold and out of stocks. So gold has a big run until the middle of 2011, and then it took until almost now. We're not even back there yet for the in terms of the ratio of gold versus the G fund. So for all this time here, from 2012, 2025, you'd have been better off in the G fund than gold. It's kind of unbelievable. I wasn't expecting that, but there you go.
That's why data is good and not opinions.
Yeah. F fund, a little bit different. Again, gold has this giant run relative to the F fund, had a big run, but then fell way off and went sideways for quite a while. And now the F fund just now, or gold rather, is just starting to get back above where it peaked in terms of the ratio back in 2011. So there are tools. They're all tools. Everybody that says, gold is the answer, or Bitcoin is the answer, or bonds, or stocks, or whatever, there's a time and a place for all of these things. And our job is to look at the chart and figure out when the trend changed. How hard would it be to look at this chart and draw a channel, right, and say, okay, when it broke the channel, I'm getting out of gold and into the F fund, because now when the line goes down, the F fund is outperforming gold. So if you were only trading back and forth between the F fund and gold, it would have kept going for you. You know what I mean? And then I thought this was the most interesting one of all, because a lot of people, they call them gold bugs. Gold is, you always should be in gold. It outpaces stocks, and people do statistics and metrics and all this. This is a very simple chart. This is gold versus the C fund, basically the S&P 500, right? So again, 2007, great financial crisis, big move higher in gold. I don't know that the price of gold was going up because it's relative to the C fund, which was going down a lot at that time. So remember, this is a relative chart. It's not an actual price chart, right? So gold was going up relative to the C fund in a big way going into 2009 because stocks were tanking. So it's possible that gold, I don't know the answer to this, but it's possible that gold was also going down, just not going down as fast as the C fund was. But, once we get to 2012 and we know the stock market's basically, the S&P has been going up since then, gold has been completely falling relative to the S&P 500.
Right. And again, just as a reminder, it doesn't mean that gold is going up or down per se. It's
relative to the S&P. Yeah.
One is going up faster than the other. And so if you know that, if you have the opportunity to be in one versus the other, that these ratio charts help you figure that out. These are very useful tools, and they're so simple. Yep. If you want to decide between the C and an S, this is how you do it. Yep. Generally speaking, they're going to flow together, but there are going to be times, and sometimes long periods of times, when they don't. And you would want to take advantage of that. Why wouldn't you? Just saying 50C, 50S blindly doesn't, it works.
Yeah. They tend to trend in the same direction.
Yeah. It's just that if one's beating the other, why wouldn't you be in the one trend? And this helps you, particularly when they're not correlated the same, like gold and the C fund. If you just make the assumption that long-term gold's going to hold its value better than a stock. Well, not according to this chart.
That's not what's happened.
Yeah, exactly. And this is the S&P, which is, largest companies, and that would give you the best inclination that, well, maybe not so much.
Well, people say, like, if I have gold, an ounce of gold would buy a car in 1930, and the same ounce of gold would buy a car today. Right, it holds its against inflation. Well, that may be true. Like, for the example, let's say that's true. If you bought a share of the S&P 500 in 1930, you could way more than buy that car today if you sold that share.
You're going to be buying more than a car,
right?
Yeah.
I mean, it's everybody has a different way of looking at the world. All right, TSP fund charts. So. Like you said, we're back. We're not back. We're now using the actual TSP fund data. So as of Thursday's close, because I can't, Thursday's close. We're doing this on Friday. The S&P or the C fund was at 92.05. It was up 0.47 for the week. We are still well above that 20-week moving average line. Relative strength is actually picking up. We talk about this all the time, the divergence between price and relative strength. So as price is going up, we want to see relative strength go up. And if you connected those lines, until a couple of weeks ago, we were clearly diverging, right? The momentum had peaked right here, which was this top, right? So momentum has been waning, even though price has been moving higher. And it's a lot of times that's a red flag. It's a condition. It's not a timing. It's not a timing tool. It's a condition. It means that momentum is waning, but apparently momentum has picked back up because it's gotten above that trend line. So it's very possible it resets, and momentum, we get back above that 70 line, and price keeps going. It's absolutely possible. S fund, really nice breakout this week. As of Thursday's close, it's up 1.52%. It's going to be, I'm not sure what it's up on Friday, but it's going to be more than 1.52 for the week. Very good chance we see some kind of resistance here at the prior high. The C fund has been well above its prior high, but the S fund is just getting back to its 2021 all-time high. We got a good breakout ultimately from that channel. So, and as long as rates continue lower, and money keeps getting pumped into the system, which is certainly happening, S fund should continue to outperform. I fund, look, I mean, it's been down for the last couple of weeks, but it's not rolling over hard, right? And I would be pretty amazed not to see support on the I fund at that 20-week moving average line. The biggest thing for me is to continue to see support at that 50 RSI. So if the I fund continues down to that 20-day, we should get support there, and it should be about the same time it gets down to 50 RSI. And then the same sort of thing for the F fund. Everybody thought that when the Fed started cutting rates, that rates would come down. And it's almost a cliche, like the Fed doesn't control the rates. It controls the Fed funds rate,
Yep.
which is all it is the interest rate that banks charge each other for overnight lending.
I just had that conversation with somebody at breakfast this morning when I was in the hotel. About mortgage rates.
Yep.
Why aren't mortgage rates going down? Well, they have gone down a little.
No, they've gone up the past 3 weeks.
Yeah, but I mean, they went down.
They went down. Yeah.
And they've gone. And I had to, rather than try to explain that part.
Yeah.
All I had to do was go, you're making the assumption that the Fed funds rate makes that rate.
Yep.
It's like goes together, and it couldn't be farther from the truth.
Yep.
Because first of all, this goes off on another tangent, but it's the same idea, right? Well, why wouldn't mortgage rates, work the same way? Because there's so many things in between the Fed funds rate and what a bank is going to give you on a mortgage rate. So what they're usually talking about is the lowest possible mortgage rate, first of all.
Yeah.
Right. So you may not qualify for that rate based on your income, your credit, and blah, blah, blah. Right. All the things. And also a bank determines the mortgage rate they're going to be able to do based on all the things that happen between the Fed's fund rate and that. All the different things going on between it. They don't equal. Yep. And so just because one goes down doesn't make the other one go down. And we're seeing that. Right. And so they started bumping up again. But, they do impact.
It does.
It does impact.
It impacts it.
It's just not.
It's not one for one at all. I mean, what this is basically telling you, the long bond is going, rate on the long bond is going higher. That is the bond market saying that they think inflation is going to be higher in the future. So if you're talking about a 30-year bond on a house, they think inflation is going to be higher in 30 years. If you're looking at the 10-year Treasury yield.
Yeah, which is better to look at if you want to look at where mortgage rates are going. The 10-year Treasury yield, right?
10-year is the most important bond yield to watch.
Yeah. But
it's significant. It's much closer to the 30 than it is to the 2-year, which is what, the Fed funds basically controls. Bonds are a little bit tricky to get your head around, but once you do, it's way more cool. It's way more interesting than the stock market.
It's why they have a whole thing called fixed income, where people, that's all they do is study that stuff. It has nothing to do with stocks.
No, it's pretty cool, bonds. And anyway, this is the G fund. The chart looks great. Looks like, wait a minute, you're making a ton of money in the G fund. Not really. The percentage difference between where we were here in 2020 at the beginning of 24 at $18 and where we are now at $18.59, it's not a very big percentage move. But I throw the chart up just because now we have it and nobody else has it, and it's a chart of the G fund, which is kind of cool.
Yeah, and it's interesting to me when we looked at it that it's not a straight line.
Yeah,
it shouldn't be. Yeah, but there's times in there where it flattens out, but it always quote unquote goes up. And it cannot by law go down.
All right, a lot of stuff this week. I thought. Questions.
A lot of good stuff.
Yeah.
All right, guys. If you have questions, put them in the comment section wherever you find the video. If you don't have a comment section, you can always shoot us an email, support@growmytsp.com. The support team will shoot it over to us. If we can answer it, we will. We like to get comments. We like to get questions. It's stuff we can talk about in the show, and it also gives us some insight into what everybody's thinking about.
Yep. Awesome.
If you like it, and I hope you do, please share it with your friends. And we will see you guys
later
next week. Cue music.